Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Upstart.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And a quick note before we get into today's stock. If you need emergency cash and want to look at a short-term installment loan option, you can check out MaxLend Loans through my link below. Eligible customers may qualify for loan options up to $3,750, and funding may be available quickly if approved. But please be careful. Always read the full loan agreement, APR, fees, repayment schedule, and total costs before signing anything.
Okay, so I need you to scrub all that traditional Wall Street logic from your brain for a second.
Yeah, just throw it out completely.
Right, because today we are looking at what I can only really describe as a classic Wall Street murder mystery.
Oh, I like that. A murder mystery.
It really is. I mean, I want to paint a picture for you here. Imagine a company that just delivered a massive 44% year-over-year revenue increase.
That's huge.
It is. That was in the first quarter of 2026. They raked in $308 million in revenue. And they grew their overall loan originations by an incredible 61%.
So they're just firing on all cylinders, basically.
Exactly. By almost every traditional metric of top-line growth, they just absolutely crushed it. And yet, and this is the mystery, right after earnings were released, the stock suffered a sharp 11.67% gap down.
Ouch. Yeah, that's brutal.
Right. And just to be clear for you listening, a gap down means the stock opened the next morning at a price significantly lower than where it closed the day before. It literally leaves an empty gap on the chart.
It's just pure overnight panic.
Exactly, pure panic. So how does a company beat revenue expectations, grow originations by over 60%, and, still see its stock punished this violently?
Well, it is a fascinating disconnect, and it really comes down to a financial mechanism we call the price of perfection.
The price of perfection.
Yeah. When a stock runs up super aggressively heading into an earnings report, the market isn't just looking for good numbers. I mean, it is demanding absolute, flawless execution across every single metric.
Right. There's no room for error.
None. And what happened here is that while the top-line revenue growth was spectacular, the upfront investments required to generate that growth heavily squeezed their profit margins.
Ah, so it's a margin issue.
Exactly. That sudden margin compression completely spooked the short-term retail traders and, of course, the trading algorithms. But what's really fascinating here is that this exact dynamic, sacrificing a bit of short-term profitability to capture market share, it might have just created an incredible long-term opportunity for you. That is, if you're willing to look past the next quarter.
All right, let's move into the wealth-building context. Because if Wall Street traders are dumping this out of short-term panic, it begs the question, what are they missing that a long-term wealth builder needs to see?
Right, we need to unpack the underlying thesis. Upstart's whole mission is essentially to replace traditional FICO-based credit models with their own proprietary AI underwriting.
Okay.
And they are targeting a massive 35% revenue compound annual growth rate, or AGR, from 2025 all the way through 2028.
Wait, I have to push back on this a little bit.
Sure, go for it.
Traditional banks have been lending money using standard credit scores since the 1980s. I mean, the system generally works, right? Why should you, as an investor, care about AI underwriting? Aren't we just slapping a trendy AI label on a simple personal loan to, pump the stock price?
It is so easy to be cynical about AI right now. I completely get it. But this is far more than just a trendy label. You really have to understand how blunt traditional FICO scores actually are.
What do you mean by blunt?
Well, traditional models look at a very rigid, limited set of variables. Things like your credit utilization or the length of your credit history.
Standard stuff.
Right. But imagine a travel nurse who makes a very high income.
Yeah.
Because she moves frequently for contracts and maybe she recently paid off all her credit cards, she has a thin, recent credit history.
Oh, I see.
A FICO model looks at her and basically says, high risk, reject. Because it's such a blunt instrument, banks have to be overly conservative. They reject a massive pool of people who would actually pay them back perfectly.
And on the flip side, they probably take losses on people with good scores who still default.
Exactly. It happens all the time.
Okay, so traditional FICO is basically like judging a restaurant solely by its municipal health inspection score.
Oh, yeah.
I mean, it tells you what not to eat, and it checks a few basic boxes, but it doesn't actually tell you if the food is any good.
That is a perfect way to look at it. Upstart's AI, on the other hand, is like reading thousands of detailed, verified customer reviews.
Oh, wow.
Yeah, their algorithm looks at thousands of alternative data points. We're talking employment history, educational variables, really nuanced spending habits, to find these invisible correlations that traditional models just completely miss.
So they can look at that travel nurse and see the full picture.
Exactly. They immediately identify that she is highly creditworthy, and right now their personal loan model is reporting an accuracy lead of a staggering 173.6% above the benchmark.
Wait, 173% more accurate. Are you
I
serious?
am.
That is not an incremental single-digit improvement. That is a complete paradigm shift in risk assessment.
Exactly. And when you understand that mechanism, it creates what we call a virtuous cycle. Better risk separation allows Upstart to approve higher rates of borrowers while keeping their actual loss rates significantly lower.
Makes sense.
And when you can offer that kind of reliable performance, lending partners just flock to you. They now have over 100 lending partners, banks, credit unions, all operating on the platform.
Wow, over 100.
Yeah. And here is the true wealth building kicker. Every single time a new partner joins and processes a loan, more behavioral data feeds back into Upstart's AI machine.
Oh, so it just gets smarter and smarter.
Exactly. It makes the model even more accurate for the next loan.
Yeah.
It creates this massive compounding competitive moat that is incredibly difficult for legacy banks or new startups to replicate.
Because they don't have the data.
Right. And that compounding data advantage is what builds massive wealth over time.
Now let's look at the fundamentals because, talk is cheap. If this AI moat is as revolutionary as they claim, you would expect to see it translating into cold, hard cash.
You would think so, yeah.
But looking at their Q1 2026 ledger, the reality is, well, it's a lot messier.
It really is.
The top-line growth is undeniably strong. Originations hit $3.4 billion. Transaction volume jumped 77% to over 425,000 loans.
Massive volume.
And here's a number that really stands out to me. Over 90% of these loans are fully automated, like no human loan officer intervention at all.
Which, by the way, is the holy grail for a fintech platform. That level of absolute automation gives them a structural cost advantage that traditional brick-and-mortar lenders simply cannot match.
Right, but here is where my risk-aware side starts flashing red. Despite all that beautiful automation, we saw a serious margin squeeze this quarter.
We did.
Let's translate some of these metrics for the listeners. Their contribution margin fell to 50%, down from 55% the year prior. Their adjusted EBITDA margin, which is basically the core cash profit the business generates from day-to-day operations when you strip out the accounting noise, dropped from 20% down to 13%.
Pretty steep drop.
Yeah. And they posted a GAAP net loss, the official bottom line loss of $6.6 million, which translates to a negative 7 cents per share.
Right.
On top of that, their cash position dropped to $472.9 million, down from where it was at the end of 2025. And their total borrowings increased to $1.92 billion just to support all these loans.
It's a lot of debt.
So if the tech is so incredibly efficient, why are the margins actively shrinking? To me, it feels like building a massive infrastructure project.
How so?
It's like laying down fiber optic cables across the entire country. The upfront cost is incredibly heavy, it requires taking on debt, and it hurts your margins today, even if the data flows profitably tomorrow.
Keep that fiber optic analogy in mind, because it aligns perfectly with what management is doing. You have to lay the expensive cable before you can charge for the data flowing through it.
Exactly.
The CFO explicitly addressed this margin compression on the earnings call. He stated that the Q1 operating expenses were heavily front-loaded. You see, Upstart isn't just doing unsecured personal loans anymore.
Oh, right. They're expanding.
Yes, they are expanding into completely new, massive verticals like auto loans and home equity lines of credit, or AKLOs.
And those are very different beasts. I mean, an auto loan requires integrating with dealership networks, handling state-by-state DMV title transfers.
Yeah, totally
You
different.
can't just click a button and automate that overnight.
Exactly. Scaling those complex new products takes heavy, upfront marketing and operational spend. But the CFO guided that this first quarter represents the absolute low point for the year in terms of margins.
Okay, so it gets better from here.
They expect sequential improvement every single quarter from here on out. In fact, despite the Q1 drop, they confidently reiterated their full-year targets.
Really? Even after that drop?
Yeah. They are still projecting $1.4 billion in total revenue for 2026, and they are maintaining that 21% adjusted EBITDA margin target for the full year.
Wow. Think about the math there. To hit a 21% margin for the full year after dropping all the way to 13% in Q1, the back half of the year has to be incredibly explosively profitable.
It really does. And plus, they used $100 million of that cash you mentioned to repurchase 3.2 million of their own shares.
That brings us to the catalyst timeline. So we have a company burning cash now to build the infrastructure of tomorrow. But as an investor, you don't want to wait forever.
Right. Nobody wants dead money.
What is the actual spark that flips this from a money pit into a profit engine over the next 3 to 6 months? What are we looking for?
There are a few major catalysts converging right now. First is a major product launch. They just rolled out a new revolving credit product called the Cash Line.
Cash line, okay.
Yeah, and Upstart's CEO was incredibly bullish on this. He actually stated it was the best first day they have ever had for any new product launch.
Oh, wow. Ever. That's a strong statement.
It is. And that opens up a totally new recurring revenue stream outside of their standard installment loans. Second, we have the Q2 2026 earnings report coming up in early August.
That's going to be a big one.
Huge. The market's going to be hyper-focused on that specific report. Investors will demand concrete proof of that sequential margin improvement the CFO promised.
And what about the macro environment? I know there is also talk about a regulatory play here.
Yes. So there is a highly speculative but a potentially massive catalyst regarding a national bank charter. Upstart has officially applied for one. Because currently, lending laws change at every state border, creating just a nightmare of compliance costs. If a national bank charter is approved, it would allow them to bypass that state-by-state regulatory patchwork.
They could just expand seamlessly across all 50 states under one rule book.
Exactly, which would drastically reduce operational complexity. Alongside that, we're watching the broader macro trends. Stabilizing interest rates would lower their cost of capital and stimulate even more borrower demand.
Makes sense.
Plus, there have been lingering fears about a systemic crisis in the private credit sector. But major players like Morgan Stanley have recently assessed that while the risks in private credit are real, they are absolutely not systemic. That removes a very dark cloud hanging over the whole fintech sector.
I have to step in here, though.
Go for it.
Relying on a regulatory charter approval, which, let's be honest, involves notoriously slow, unpredictable government bureaucracy, or hoping for the Fed to stabilize interest rates, that seems like way too much of a gamble for anyone protecting their downside.
That's fair.
I mean, you cannot model government efficiency into a discounted cash flow analysis.
Oh, you know you can't.
Yeah.
And you're completely right to be cautious about the charter. You never want to base a core investment thesis on a regulatory approval that may or may not happen on your timeline.
Exactly.
You should treat the bank charter purely as a potential bonus, like a cherry on top. However, the rollout of the Cash Line product and the Q2 margin expansion are hard operational realities. Those are factors entirely within Upstart's control.
That's a very good point.
The underlying demand for their core product is already proven by that massive 61% growth in originations. They simply do not need the bank charter to hit their 2026 financial targets.
Now let's pivot to the chart to see how this is playing out in real time, because the technical price action is telling a completely different, highly volatile story.
Very volatile.
I want you to visualize this chart. In April of 2026, the stock was on an absolute tear. It jumped 23% overall for the month.
Huge month.
And within that run, there was a massive 13% single-day surge on April 15th that was directly driven by the hype and announcement of that new Cash Line product we just discussed. The momentum was purely bullish. But here is the danger of momentum. That run-up meant absolute perfection was priced into the stock at $31.17 right before earnings.
And as we established, Q1 was the quarter of messy, front-loaded infrastructure expenses, not perfection.
Exactly. So when they reported a headline, EPS missed coming in at negative 46 cents versus the consensus estimates, the reaction was violent.
Extremely violent.
We saw that gap down of 11.67% on May 5th, bringing the price tumbling all the way down to $27.53. It was a textbook sell the news algorithmic drop. The stock fell right down to a critical support level.
And what's really fascinating about price action like this is dissecting the mechanics of who is actually doing the selling and who is doing the buying. When you see a violent, immediate gap down on a headline EPS miss that is almost entirely driven by algorithmic trading systems, these computers read news headlines in milliseconds. They see the keywords margin compression or EPS miss and they're programmed to automatically execute massive sell orders before a human can even blink.
Which then triggers retail traders to panic and sell as well.
Exactly. But if you look deeper into the institutional flow, the smart money operates entirely differently. Institutional investors recognize that the underlying loan demand is surging. They often use these specific moments of high retail volatility and algorithm panic to accumulate millions of shares at a discount.
So what does market sentiment look like behind the scenes? This is where I get really conflicted. If the algorithms are dumping shares, what exactly are the heavy hitters doing to show that institutional sentiment is actually strong?
Well, the institutional interest right now is actually staggering. And it completely contradicts that post-earnings algorithmic sell-off.
Give me the numbers.
Year to date, Upstart has secured over $4 billion in new capital commitments.
Wait, 4 billion?
$4 billion. That includes massive forward flow agreements. They signed a record 24-month, $1.25 billion deal with Fortress Investment Group. They signed another $1.2 billion agreement with Centerbridge.
Those are heavyweights.
They are.
Yeah.
And on the equity side, the hedge fund Halter Ferguson just stepped in and purchased $37 million worth of shares.
Oh, wow.
We are also seeing new traditional partnerships, like a recent deal with Justice Federal Credit Union to expand their personal lending. And just before earnings, the average analyst price target was sitting at $43.93, which implies huge upside from the mid-20s where it is currently trading.
Okay, there is a glaring contradiction here that we have to resolve. On one side of the screen, algorithms and retail day traders are dumping the stock because of a quarterly margin dip.
Right.
On the other side of the screen, massive institutions like Fortress and Centerbridge are locking up billions of dollars in multi-year agreements. Who is right here?
It's the ultimate showdown.
Are the algorithms seeing a fatal flaw that the institutions are blind to, or are the institutions playing a game the algorithms don't understand? Let's clarify what a forward flow agreement actually means for you listening.
It completely comes down to the time horizon and the depth of research. Algorithms are looking at the next millisecond, reacting to a headline. Institutions like Fortress are looking years ahead.
Right.
Let me explain that forward flow commitment because it is crucial. Fortress isn't just buying Upstart stock on the open market. They are literally backing a dump truck of their own capital up to Upstart's platform and saying, "We trust your AI to lend our money to borrowers."
That is a massive vote of confidence.
It is. A 24-month forward flow commitment means Fortress has deeply audited Upstart's AI credit performance. They've stress-tested it against every scenario, and they've decided it is mathematically superior to traditional underwriting.
They wouldn't risk $1.25 billion otherwise.
Exactly. That represents the ultimate long-term conviction. That kind of structural validation from a financial heavyweight completely outweighs short-term millisecond trading sentiment in the long run.
But it's not all sunshine. Now let's talk about the risks. We can't just talk about institutional validation without talking about the very real ways you could lose your shirt here.
Always have to look at the downside.
Protecting your downside is just as important as projecting the upside, and there is a very real bear case here that we cannot ignore. First and foremost is the litigation overhang.
Yes. The lawsuits.
Multiple law firms are currently launching class action securities fraud lawsuits against the company. Now, even if you believe these lawsuits are entirely baseless ambulance chasing, they create persistent negative headline risk.
They absolutely do.
They distract the executive management team, and they burn through precious legal capital that really should be going toward engineering, AI development, and growth.
It is a highly valid concern. Institutional compliance departments absolutely hate ongoing litigation. It can sometimes prevent certain risk-averse funds from taking a position until the legal cloud officially clears.
Exactly. And beyond the legal headaches, there is severe execution risk. We talked about Upstart expanding into those new verticals like auto loans, HELOCs, and the new cash line. Auto and real estate lending are entirely different beasts compared to unsecured personal loans. The bear case essentially argues that these new verticals require so much heavy ongoing marketing and operational spend that they might permanently drag down Upstart's previously capital-efficient model.
That's the fear.
If management's forecast about Q1 being the trough for margins is wrong, and these new products remain incredibly expensive to run, that 21% EBITDA target for the year is a total pipe dream. Add in the fact that they are sitting on total borrowings of $1.92 billion on the balance sheet, and a misstep in execution could get very expensive very fast.
Yeah, if we connect this back to the broader picture, those specific risks, the debt, the new verticals, the lawsuits, are exactly why the stock is trading in the mid-20s instead of the mid-40s right now.
It's priced in to some extent.
Right. However, you have to look at the concrete mitigations. Regarding the litigation, class action lawsuits are practically a routine side effect of volatile stock drops in the tech sector. Law firms see a gap down on a chart and automatically file suits, hoping for a quick settlement.
That's true. It happens a lot.
But the core business data, that 61% growth in originations and the constant onboarding of new lending partners, it proves that the actual operating business remains entirely unimpaired by the headlines.
Okay, but how do you mitigate the execution risk of those expensive new verticals and that massive debt load?
You look at what management is doing with their own money. We noted earlier they executed a $100 million stock buyback in Q1, and they still have $122 million authorized for further repurchases. Think about the psychology there. When a management team is aggressively buying back their own stock in the face of a post-earnings algorithmic drop and looming lawsuits, it signals supreme insider confidence.
Because they see the internal numbers.
Exactly. They have real-time visibility into the daily performance and unit economics of those new auto and HELOC verticals. If those models were permanently impaired and bleeding cash, they would be hoarding every penny to pay down that $1.9 billion in borrowings.
That's a great point.
Instead, they are actively buying the dip. They are betting millions of their own dollars to defeat the bear narrative.
So with everything on the table, what's the final verdict?
Based on the fundamental top-line growth, the staggering institutional validation, and the temporary nature of the margin compression, the research assigned a bullish score of 8 out of 10.
An 8 out of 10, okay.
Yeah, and the target horizon here is absolutely not a quick flip. It is a multi-year hold, specifically looking at a 12 to 24-month time frame.
To bring it all back to where we started, you are looking at a company navigating a temporary, messy margin trough while simultaneously widening a massive, incredibly lucrative AI moat.
Perfectly said.
It's that exact tension between the ugly upfront cost of building the infrastructure today and the highly profitable automated flow of data tomorrow.
That is the perfect summary. This is the elevator pitch right here. This post-earnings algorithmic dip offers a compelling entry point into a true fintech leader. Their core technology is validated by over $4 billion in institutional capital commitments, and they are firmly targeting a 35% revenue compound annual growth rate through 2028.
Incredible numbers.
Yeah, by buying into the current volatility and looking past the short-term panic, you capture the operational leverage and margin expansion that is explicitly expected in the latter half of 2026.
Before we wrap up, I want you to just think about this for a second. If Upstart's AI definitively proves that millions of supposedly unlendable people are actually completely safe bets, what happens to the entire traditional banking system when they wake up and realize they've been leaving billions of dollars on the table for decades? Need emergency cash? MaxLend Loans offers short-term installment loan options up to $3,750 for eligible customers. Apply through the link below and carefully review the APR, fees, repayment terms, and total cost before accepting any offer.
And if this deep dive helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua Deep Dive.